Most traders don't lose because they can't find entries. They lose because they can't manage themselves once they're in. And one of the most expensive habits in trading is exiting winning trades too early. Here's the uncomfortable stat that almost nobody talks about. A huge percentage of retail traders are right often enough to be profitable. Their direction is fine, their timing is decent, their analysis isn't terrible. But their winners are too small, their losers are too big, and the math never works out. Not because the market is impossible, because the mind quietly sabotages the payout. Think about how crazy that is. You can be right and still lose, over and over. Mark Douglas said it best. The hard reality of trading is that each trade has an uncertain outcome. Most traders hear that. Few actually live by it. Because the moment your trade becomes a winner, your brain pretends certainty is possible, and it tries to grab it before the market takes it back. If you want to actually change the way you trade, hit subscribe and click the bell so you don't miss the fix. This channel is Mind for Trade, and we train the part that really decides your results. The problem is not that you take profits. Taking profits is not a sin. The problem is the emotional reason behind it. Exiting winners too early is usually not a planned decision. It's a relief response. It's your nervous system trying to end uncertainty as fast as possible. It's subtle. It feels responsible. It feels disciplined. You tell yourself you're protecting gains. You tell yourself you're not being greedy. You tell yourself profit is profit. And on the surface, that sounds mature. But under the surface, it's a hidden habit, a reflex, and it controls trades automatically. It often shows up with the same trio of behaviors. You overtrade after missing a bigger move. You hesitate on the next good setup because you're still annoyed. And when you finally get a small win, you grab it like water in a desert. That cycle is emotional self-regulation, disguised as strategy. Have you noticed how some trades that should be easy winners suddenly turn into losses? It usually starts the same way. You enter well. Price moves your way. Your position is green. You feel the spike of relief. Your mind whispers, finally. And instead of following your plan, you start staring at the profit. Not the chart, not structure, not the reason you entered, just the profit. Then one candle pulls back. It's normal. It's healthy. It's literally how trends breathe. But your brain doesn't interpret it as normal. It interprets it as danger. Because you were just up, and now you're less up, and that feels like losing something you already owned. So you hit close. You take the small win. Your shoulders drop. You can breathe again. And then the market does what it was going to do anyway. It continues in your direction. Without you. That's when the real pain hits. Not financial pain, identity pain. The sting of watching your move happen without you. The brain calls that regret. And regret is gasoline. So what do many traders do next? They chase. They re-enter late. They buy higher. They sell lower. They take a worse price just to get back in. Because being out feels like being wrong. Now your risk is worse. Your stop is tighter. And the market finally pulls back for real. You get stopped. Your small, safe profit gets erased by the next impulsive loss. And the mind learns a dangerous lesson. It says, see, we should take profits fast. We can't trust the market. So the habit gets stronger. Many retail traders repeat this mistake unknowingly over and over. They build a whole identity around being safe, but the account balance tells a different story. Here's the part that stings, but it's true. Exiting early is rarely about money. It's about emotion. It's about wanting certainty in an uncertain environment. And markets don't pay you for wanting certainty. Markets pay you for managing uncertainty. A common scene. You're in a trade that's finally working. You've been red for days. You've been doubting yourself. And now you're green. Your brain is not thinking about the next hour. It's thinking about survival. It's thinking about ending the discomfort of being exposed. So you close. You secure the win. And you feel like you did something right. But profitability isn't about feeling right. Profitability is about executing well. Another scene. You're up. You see profit. And you start doing mental math. If I take this, I'm back to break even for the week. If I take this, I'll feel better. If I take this, I can finally relax. That's not trading. That's emotional accounting. And the market does not care about your weekly break-even. The market does not care that you want to relax. The market only responds to order flow, liquidity, and probability. So why does this matter so much? Because consistency is not built on being correct sometimes. Consistency is built on a stable process. And a stable process requires stable exits. When your brain autopilots trades, it reacts emotionally. It overreacts. It freezes. It makes impulsive decisions that destroy your edge. Not once. Repeatedly. Exiting winners too early is one of those decisions that looks small in the moment. It feels like a harmless click, but it attacks the core engine of your account. Expectancy. If your average win stays small, you must win constantly just to survive. That forces pressure. Pressure forces mistakes. Mistakes create losses. Losses create more pressure. And now you're not trading the market. You're trading your own stress level. Most traders never notice the real cause. And it costs more than just money. It costs confidence. It costs clarity. It costs the ability to trust yourself. And once trust is damaged, you start needing signals and confirmations just to take a normal trade. That's when people spiral. So let's get practical. How do you recognize this habit and actually fix it without turning trading into some mystical self-help project? Start with awareness that is specific. Not vague, not, I was emotional. That's useless. You want clean data on your mind. Before you enter a trade, pause and name what you're feeling in plain language. Are you calm? Are you excited? Are you trying to make money back? Are you bored? Are you afraid of missing out? Are you trying to prove something? If you can't name it, it will control you. During the trade, check in when the position turns green. That is the danger zone for early exits. The moment it goes in your favor, ask one question. Am I about to close because my plan says so, or because I want relief? After the trade, write one honest sentence, not a story. One sentence. I exited because I saw structure break. Or, I exited because the profit felt like it might disappear. That second sentence is gold, because it reveals the trigger. When you track this for a couple of weeks, patterns become obvious. You'll notice you exit early after a losing streak. Or you exit early when the profit would put you positive on the day. Or you exit early when you're trading larger size than normal. Or you exit early when you're watching every tick on a lower time frame. Awareness is the first form of control, not because awareness magically fixes you, but because it removes the illusion. You stop thinking, this is just my style. You see it as a repeatable behavior with repeatable triggers. Next, build a pause between impulse and action. This sounds simple. It is simple. And that's why most people underestimate it. When you feel the urge to take profit early, don't fight the urge with willpower. Just slow it down. Give yourself a tiny delay, a breath, a brief checklist, a single question. Am I reacting, or am I following a plan? That micro pause interrupts autopilot. It forces your prefrontal cortex to come back online. It turns a reflex into a decision. And here's the key. You don't need to be fearless. You need to be structured. Structure means you define exit conditions before you enter. Not in a perfect way, in a repeatable way. You decide what would make you exit for profit, what would make you exit for invalidation, and what would make you do nothing. A simple example. You enter on a breakout with a clear level. Your plan says you will not take profit just because you see green. You will take profit when price reaches the next logical area where opposing orders are likely to sit, or when the market prints a clear sign that the move is losing momentum based on your method. Until then, you allow normal pullbacks. Now notice what just happened. You moved the exit trigger from emotion to evidence. If you're a beginner, you can make this even more practical. You can decide that you will not touch the trade until either your stop is hit or your planned target is hit. That's it. No negotiation mid-trade. No, just this once. Because the mind uses just this once to rebuild the habit. If that feels too rigid, there's a bridge strategy that helps many traders. Partial exits with rules. You take a small portion off at a reasonable area to reduce emotional pressure, and you leave the rest to follow the plan. The point is not to be clever. The point is to stop your nervous system from hijacking the entire position. But even partial exits can become a crutch if you use them as permission to avoid holding. So you keep it rule-based. You don't do it because you feel like it. You do it because it's your system. Now let's add the AI framing, because this is where people level up fast. Most traders make exit decisions based on the latest candle and the latest emotion. AI-assisted probabilistic thinking flips that. It asks, what does my data say about what usually happens after this setup, with this stop, at this time, in this market condition? You don't need a fancy model to start. You can use a simple tracker. Tag your trades. What setup was it? What time frame? What was the reason you exited? What happened after you exited? Did price hit your original target without you? Did it stop you out anyway? Did it reverse immediately? After enough samples, a painful truth often appears. The trades you cut early frequently go on to reach your intended target, and the trades you hold according to plan do not magically become losers more often. Your mind just remembers the few times it gave back profit because those moments hurt more. That's negativity bias. Your brain weights pain heavier than gain, so it overlearns from rare painful events and underlearns from common positive ones. An AI-style approach is basically this. Let the data set correct your memory. Let statistics replace emotional storytelling. Here's a believable example. A retail trader tracks trades for a month and notices something. Whenever a trade reaches a modest profit and then pulls back slightly, they exit. In their journal, the reason is almost always the same. I didn't want it to turn into a loss. When they review what happened after exit, most of those trades continue to the original target. That single insight changes everything, because now the trader isn't trying to be brave. They're trying to stop leaking expectancy. So they add one rule. If the setup is valid and the market has not hit the invalidation level, they do not exit during normal pullbacks. They only exit if the market breaks the structure that justified the trade, or if the planned target is hit. The first week feels uncomfortable, because your body is used to escaping uncertainty. But the second week feels cleaner, and by the third week, the trader starts to experience a new emotion. Trust, not hype, not confidence from one big win. Trust from repetition. Are you already doing any of this, or does it feel completely new? Be honest with yourself here. Many traders ignore these signals and continue losing without understanding why. Because early exits feel like a personality trait. I'm just conservative. I'm not greedy. But if that conservatism is unplanned, it's not conservatism. It's fear disguised as virtue. Let's go deeper, because there's a core belief underneath early exits that almost nobody confronts. The belief is this: if I don't take profit now, I might lose it. That sounds logical, but it hides a trap. It assumes the money is already yours. The moment you see green, your brain starts treating unrealized profit like owned profit. So when the market pulls back, it feels like something is being taken from you. That sensation is called loss aversion, and it is powerful. In trading, that means you'll often take a small, certain gain to avoid the possibility of a larger, uncertain gain. You choose relief over expectancy. And if you do that a few hundred times, you build a career of small wins and occasional large losses. Because when you take profits early, you often move stops, widen stops, or re-enter emotionally. And that's where the big damage happens. Now think of the invisible habit, controlling your trades as a chain reaction. What is it really? It's the automatic relief exit reflex, the compulsion to end uncertainty the moment you are in profit. Why does it exist? Because your brain is designed for survival, not performance. It wants to reduce stress now, not optimize returns later. It builds unconscious risk because it encourages you to compensate later with impulsive entries and bigger size. It triggers emotional reactions because it makes you feel regret, and regret creates urgency. And it undermines consistency because it breaks the relationship between your edge and your execution. When you sit down to trade, say it in your head. I get paid for following my rules, not for being right on this one trade, not for catching every tick, not for avoiding discomfort, for following the process. And if you want a single sentence to use in the moment you're tempted to exit early, use this. I don't manage profit. I manage risk. Because risk is the only thing you can truly control. This is also where position sizing becomes psychological medicine. If your size is too big, you will exit early. Not because you're weak. Because your nervous system is overloaded. The chart will feel louder than your plan. So if you keep exiting early, consider the uncomfortable possibility that your size is forcing you into survival mode. Smaller size can be the fastest way to fix early exits. It gives your brain room to stay rational. Also, stop staring at the money. If your platform shows profit in dollars and it spikes your emotions, change it to points or percentage. Make it less personal. Make it less like rent money. The more personal it feels, the more your nervous system will protect it. And watch your environment. If you're trading with distractions, if you're tired, if you're checking messages, if you're trying to trade while emotionally charged, your autopilot will run harder. You will default to relief exits because your brain doesn't have spare bandwidth to stay disciplined. If you want to take this to an even higher level, you can rehearse holding winners. Literally, outside market hours, open old charts and practice the feeling of staying in during pullbacks while following your exit rules. Athletes do this. Traders almost never do. But the brain learns from rehearsal too. One more expert insight to anchor this. Brett Steenbarger said, "The best traders don't trade their emotions. They use their emotions to inform them. That means the fear you feel when you're up is not a command. It's information. It's a signal that your brain is interpreting uncertainty as danger. You don't obey it. You observe it. So the next time you're up and you feel the urge to close, don't shame yourself. Don't call yourself undisciplined. Just label it. Relief-seeking. Then return to the plan. That's how you turn psychology into execution. You don't have to be among the traders who keep losing the same way. You can become a conscious risk manager. The kind of trader who controls micro-decisions. The kind of trader who lets probability play out. The kind of trader who doesn't need the market to feel comfortable in order to behave professionally. Subscribe if you haven't yet. Hit like and comment which habit you're focusing on first. Are you training the pause? Are you journaling the real reason you exit? Are you using data to challenge your memory? If you're ready to evolve your trading mind, this is your next step.